Hello, this is Michael Brooks with Prophetic Capital, and I hope you had a wonderful Memorial Day weekend. And we're almost halfway through the year, and I wanted to take a look at stock prices, some different asset class performance, show you kind of where we're at so far this year, and to give you some encouragement on the recovery we've seen in the markets, but also to help again focus us on looking at the long term and not being caught up in the short term when it comes to investing. So one of the things I wanted to give a caveat here, as I had mentioned in a previous email, but I wanted to reiterate it here, is that it is a difficult line for me to walk, honestly, when it comes to this kind of environment that we're in, where everything seems quite political, and it is. A lot of things are changing very rapidly, but I wanted to give a little bit of a context, a little bit of a focus on the long term, and to see what analysts are saying, what some of my research has been showing, and just to give you kind of where we're at year to date and what's happened so far from my point of view. So if we start here, we look at the Dow Jones Industrial, and we started off the year on a pretty hot note, but after a lot of the tariff announcements, markets were spooked and had quite a bit of a fall, especially some extremely heavy volatility in April, as you can see here, reflected in the Dow Jones and the S&P 500, even worse on the downside, down almost 15% year to date at one point, but had a very quick recovery as a lot of those original tariffs, or the reciprocal tariffs as they were called, have been peeled back, and we're now sitting at a 10% across the board on all countries except for China, higher at 30%. Now, a lot of this is consistently changing, as we've seen with the threat of a 50% tariff on the EU, and then quickly that deadline being extended out into July from the original June 1st date. So continued volatility in the tariff world, and I am not going to delve into it. It's just too much and too many things that are going on, and it's kind of a dicey area for me to really get into on a YouTube video, to be honest. So I'm focused more on the long term and on how our portfolios have constructed with this diversification, and how it has helped amongst not just US stocks, but international as well. So we can see here, if we add in, all three major asset classes for the US, we had at one point quite a big pullback and then quite a quick recovery, and we're just slightly down for the year in US stocks. Now, if we add in the small cap Russell 2000 into the mix, small caps have been hurt fairly more than other asset classes this year, and a lot of that has been due to the increased pressure that high interest rates are giving on smaller companies versus the larger ones, who can withstand a little bit more as tariff contacts as well. But really, the interest rate environment is, I think, a key component here. And so, we don't have a crystal ball. We do not know when. We do not have a large allocation towards small caps, but we have some. And then another thing to note is that in the small cap world, that is, rewards are given to investors for taking on more risk, and eventually the capability of small caps to take off, especially if we do see at some point in the future, which we will, interest rates fall. Small caps will stand to benefit far greater than the valuations that are high in the large cap space provide. Small caps are very on sale right now, and have been for quite some time. And just wanted to point this out, that the underperformance there is expected. It's a volatile asset class more than large caps, but we will be rewarded for staying firm in the long term when interest rates do fall. And to give a counterbalance to the US stock performance this year, we have international stocks. And here I'm showing the developed market index as represented in this pink line here. And you can see quite the outperformance versus US stocks. And there's two main reasons that I see for this. One is that the dollar has weakened quite a lot so far this year versus some of the major currencies like the yen or the euro. That has contributed quite a bit to the performance differential, but also I think really a lot of what has happened, either with a lot of the tariffs being announced or a lot of the war with Ukraine and Russia becoming at the forefront, that the US will not necessarily be in the same role that it was in the past, I think has caused Europe to spend more and to sort of militarize a lot more by increasing their spending across the board throughout a lot of the main European countries. That has really helped prop up stock prices in those markets versus the US. Again, we have no idea if this will change, if this kind of uh, environment will stay the way it is, where we continue to see quite a bit of outperformance. And I think that at least from the dollar point of view, we might have sort of a base or consistency there. But as far as the future of stock market prices, again, no one really knows, but our diversification and being invested in multiple different areas has helped us, and our portfolios are up for the year across the board. So, as we look at some of the predictions here, I wanted to first point out that stocks are unpredictable in and of itself, and you can see how differentiating returns have been over a very long period of time here. The last 100 years, we've seen returns all over the place, and to very uh, anywhere come close to figuring out where we're going to be at a particular year. Well, strategists aren't that great at predicting short-term stock price moves either. And so you can see here, now I'm not don't need to get into the details of this chart, just to say that analysts are all over the place in their price targets compared to what reality brings for a particular year. However, there is an indicator that we can look at in the long term that gives us a pretty good idea of where stock prices might be headed, and that is earnings. Stock prices are arguably based mostly on earnings. And if we can see here in this very interesting squiggly looking chart, let me explain how this works. So basically, you have a lot of noise. A lot of these dots are actual earnings of companies and where prices have skittered and scattered between all of here. But if we can look sort of at the average, or the line here going from bottom left to top right, even though earnings have uh, been all over into these blue lines, the trend is up. I mean, the noise here is the short-term market movements, but our focus, especially when we're looking at either saving for retirement or extending out our retirement income, we want to be focused more on the long term. And as you can see, that trend line for stocks has historically always been up over time with a lot of noise in between. So just to say that earnings do provide a pretty good picture if we're looking at more of a long-term outlook. So let's see where some strategists are looking for the next couple of years. And if we look even out at 2027 here from Morgan Stanley, we can see here that their earnings projections are quite a bit ahead of where we're at right now. Earnings per share has been forecasted in a base case of $321 as to where we're at right now, 259. So quite a bit of growth in their base case, but even in their bear or negative case, we can still see quite a bit of earnings per share growth that is pretty significant in the next coming years. Some of that has been due to a couple factors, and I wanted to point out one especially, and that has been profit margins. So when we look at profit margins, this is really amped up since the pandemic. And if you could see here in this chart to the right, how efficient companies have been in their corporate profits. So what they have basically done is used strategic layoffs. They have increased a lot of efficiency through the use of technology. And really, this is a very interesting and quite a big subject I'm focused on and really looking to as a huge factor in outperformance in especially in AI related trade. And I think this will not only affect AI stocks or technology stocks, but across the board, things will be helped immensely by the efficiency that AI brings. I think this is a reality. I think that we are only in the very beginning stages of what AI is going to bring. And, there's obviously tons of negatives, which we will get into in future videos. But for right now, my point is that so far, technology and the fact that companies have really increased their efficiency big time since COVID. So just to say that that trend seems to be continuing. So the last slide I wanted to show here, continuing with the efficiency theme, is the AI effect on different industry groups. And a global research team out of Bank of America did a study looking at maybe the implications that AI will bring to companies across their peer groups over the next 5 years or so, as we, I believe, are in the beginning stages of the impact of AI on our corporate profits and our efficiencies that companies are able to eke out through the use of technology. And we can see here, it's not just, even though it's the highest category so far, this software and semiconductors being the top, but you can see even across different industry groups like energy, real estate, banks, materials, I mean, food and beverage even benefits. We can see this across the board, and pinpointing any one sector of outperformance is tricky, but this is just a very interesting chart to show that the flow of efficiency that we're using will affect all industries. So keeping diversified and being in many, many different areas of the markets keeps us from getting trapped in a short-term move. We keep the long-term focus, and the general theme here is that, in my belief and in a lot of analysts' belief, is that AI is here to stay and will only increasingly get better and help on the productivity side for companies and their margins, is why you've seen quite an up increase like in the chart earlier. So needless to say, the future still looks very good. Earnings projections are looking quite healthy and the positive. You can see here in 2026 and 2027. And again, we have no idea the crystal ball that it's going to bring, but the big factors that are at play, if tariffs remain a minor detail on the global stage, we will see. But if that is the case, what really is going to drive a lot of profits and a lot of growth in stock prices is going to be this profitability gain that we're seeing since the pandemic. So I wanted to give this a little bit of context here and show you kind of the theme that I'm looking at and seeing where we go from here in the future. But some good news in despite all the volatility, despite the fact that we had quite a lot of down moves with some of record high recovery, is that we're flat for the year as far as US stocks. International stocks have far outperformed, part of it being the currency move, the drop in the dollar versus some of the other major currencies, but also that we have seen a pickup in spending across the board in global markets. And as well, we expect the AI trend to continue, and we're in beginning stages, and then that will further help propel prices in future years. And hopefully, some of this will also reflect in some of the more harder hit areas like small caps, as we see some of these productivity gains combined with a decline in tax policy and in efficiency that companies are bringing through the use of technology. And so that's kind of what I wanted to give you so far this year. Hope you have a great continued summer as we begin. And I am always here and available for you to schedule a meeting. Would love to meet with you to talk about anything in this detail further. But I wanted to give you kind of my thoughts so far, halfway almost through 2025. Appreciate your time. Take care. Enjoy the rest of your summer, and we'll talk soon.